Good evening. I'm Alan Murray with the Wall Street Journal Bureau here in Washington, and I'm here this evening to moderate a panel entitled After the Crash, What Lessons for the Regulation of Securities and Future Markets. The program is sponsored by the National Economists Club Educational Foundation of Washington, D.C. The timing of this panel discussion is fortunate because it comes just a few days after the Brady Task Force has released its report on the stock market crash. I spent a good part of my weekend reading over that task force report, and I can tell you it reads like a good Stephen King novel. Presents a very frightening portrayal of what happened in the stock market and the futures markets on October 19th and 20th. What the task force portrays is a market dominated by a few very large institutions making some very large trades at a time when the average investor seemed to have very little sense of what was driving the market and very little ability to get into that market at certain points. It tells a story of a market driven not so much by the trade deficit, the budget deficit, takeover legislation, or any other external event, as it was driven by a focus on its own internal mechanisms, an attempt to anticipate what the program traders would do, what the portfolio insurance would be doing. It paints a picture of the stock market that is unlike anything I'm familiar with from economics text that I've looked at, and I think that's why we're here tonight to discuss this situation and discuss what might be done about it. The purpose of our panel is basically to answer the question, what is wrong in these markets, if anything, and what can be done about it, either by the markets themselves or perhaps by government regulation. And I should point out here that while the Brady Task Force was entirely appointed by the Reagan administration, and while Nicholas Brady himself is a very close friend of the Vice President, the recommendations that are made in the report do tend to propose a very strong new system of regulation for the securities markets. They first of all call for an expanded role for the Federal Reserve in overseeing the stock market, the stock futures markets, and the stock options markets. They call for increased margin requirements, credit requirements in the futures markets, and they at least raise the possibility of putting daily limits on fluctuations in prices. So those are among the things that we'll address here this evening. But before I go any further, let me introduce the panel members. We first of all have Alana Peters, a lawyer and a member of a commissioner on the Securities and Exchange Commission since June 1984. Ms. Peters is right now in the thick of the SEC's own study on the stock market crash, and she has warned me that she's not prepared tonight to tell us all that's going to come out in that report. However, she has promised to provide us with her insights on what happened on those key days of October 19th and 20th, and I hope she'll consider it fair play if we at least make an attempt or two to draw her out further.
I would expect nothing less than from the Wall Street Journal.
Next to her is William Silver, a professor of economics and finance at New York University Graduate School of Business. Mr. Silver is also a market maker in the options and in options and futures in the New York Mercantile Exchange, the Commodities Exchange, and the New York Futures Exchange. So he brings a very interesting perspective to our discussions this evening. The Brady Task Force, of course, raises a lot of questions about how successfully the market maker system operated in the various exchanges on those 2 days of October 19th and 20th, and I'm sure we'll want to get into that later on this evening. Our third panelist, pinch hitting for Ronald Hobson, is William Hariff, who is the J.E. Lundy Scholar at the American Enterprise Institute and director of AEI's Financial Market Project. Now, let me start it off by asking all three panelists to answer the same question, a very broad question, and if possible to answer such a broad question in such a short time, I'd like to keep the answers to maybe 2 or 3 minutes. And the question is simply this: is the system broke? Is there something wrong with the stock market, the stock futures market, the stock options market? And if so, how can we fix it? Does it call for new regulation on the part of the government? And Professor Silver, let me start with you.
Well, is the system broke is kind of a broad question. The system is still around despite the fact that we had a calamitous drop on October 19th. And from that perspective, the system is very much alive to the extent that it could survive such a decline, such a precipitous decline. Whenever there are sellers only in the marketplace, you expect prices to drop precipitously. And I think it's useful, instead of focusing attention on why the market declined, I always like to say the market declined because there were more sellers than buyers at the existing price level. The reasons there were more sellers than buyers is another question, and everyone has their own particular reasons. I think that the focus should be on why the system nearly came to the brink of a standstill. And from that perspective, why, for example, the Federal Reserve had to enter as a lender of last resort, to exercise its functions as a lender of last resort to the major clearing firms that operated in the options markets, in the futures markets, and in the stock market. And I think the answer to that question lies in the capital adequacy of the clearing systems. Focusing on the clearing systems, even though it's almost viewed as a technicality, will bring us to the focal point of why the system almost came to a collapse, how the Federal Reserve courageously helped to avoid it.
And as to the second part of the question, is there a need for the government to step in, and is there a need for regulation to improve the clearing systems, or is this something that the markets can do on their own?
Well, I think there has to be a combined effort. Clearing houses and clearing firms have strong incentives to monitor themselves. They're basically profit-oriented. They're owned by various profit-making institutions, so they have a strong incentive to monitor their own credit exposure. Nevertheless, I think there probably should be a role, at least in terms of information availability with respect to the capital adequacy of the various institutions. And that probably would have allowed an emergency action by the Federal Reserve to have been transformed into a less harrowing experience. More, I wouldn't say run-of-the-mill, but more, they would have been better prepared to deal with the emerging crisis.
You would then favor giving the Federal Reserve more power in collecting information on the capital adequacy of the various participants?
I think that's a fair, yeah, I think you summed it up in 3 words.
Ms. Peters.
I agree with Mr. Silver that it's difficult to answer the question, is the system broke, because of its very breadth. However, I do think that it is quite legitimate and reasonable, and I will, if I may, rephrase the question. And that is, so I would probably answer no to your question because the system is still here. The market survived a horrendous experience and lived to tell the tale of it. But I think that what may be helpful in analyzing what happened in the 10 to 14-day period starting with, say, October 13th, 14th on through the end of the week beginning with October 19th is that the market functioned or dysfunctioned in a way that drew into question the very assumptions upon which it is based. Our market system is generally based on the assumption that in a free and informed market, there will be a buyer for whatever it is you want to sell at some point on the price scale or continuum. And it also operates on the function that it is an intelligent, rational marketplace, and that it will take into account all of the information, make its pricing decision, and act accordingly. We had in this peculiar period of October 1987 a market that did not appear to be acting along those assumptions. Buyers seemed to virtually over a 72-hour period of time had disappeared from the market. And from the point of view of a regulator, of course, we want to know why and what can we do to ensure that that doesn't happen again. And also the market was seemingly reacting price-wise, pricing its commodities, what it was selling, not necessarily in relationship to basic economic fundamentals. Something else was going on. People were behaving in a manner that did not apparently comport with the information that was available. So if you ask me as a regulator, am I concerned about that? The answer is yes. And is there something that we ought to do about it? I think, again, the answer is yes. I think that the government will have to think along the terms of regulatory intervention, but I'm not confident that that intervention has to, while it may be fairly profound, I don't think that it needs to be over-sweeping or overwhelming or over-enveloping when it comes to the marketplace. There are some very specific mechanisms that need to be examined. Capital adequacy, as Mr. Silber mentioned, is definitely one of them. Liquidity and leverage is another. Translation, margin requirements. That is definitely another area in which we need to be concerned. We need to be very concerned to see exactly how mechanisms such as the specialist system, the market-making system, actually work their way through their obligations. Of course, the specialists have certain obligations, and market makers in the over-the-counter market, and I'm going to probably pretty much limit my comments to those professionals involved in the cash market and the over-the-counter, the equity market, since that's the area of our direct oversight, except for options.
And I suppose it would be unfair to ask you whether you think the SEC should be regulating the futures markets.
Mr. Murray, if you throw that hot potato at me this evening after I pleaded with you not to,
no, I was just asking
I'll throw it
whether
right
you
back
consider
at
that
you.
unfair.
That's right. I would consider that unfair.
Okay, let me just ask you to elaborate on one point you made. You said that the market didn't appear to be acting according to the assumptions of intelligent, rational, using the information that was available and making buying decisions. Do you have any thoughts on why that was? Why the market was not acting properly?
Yes, I do have some thoughts on it, but before expressing them, I think that I would like to preface them with the fact that they are my own personal individual thoughts, and they have been formulated without the basis, the benefit of the considerable and expert analysis and investigation that our staff is currently undertaking. So although I may spout off tonight about what I think caused it, you may hear me singing a different tune a week or so from now, once I have an opportunity to review the staff's report. But interestingly enough, my own personal viewpoint on what happened is pretty close to the opinion stated in the Brady Commission report. As a matter of fact, I gave a speech on November 12th or the 11th to a group of accountants articulating fairly closely the same scenario. That is to say, what happened was a reaction by arbitrageurs and other market professionals to the announcement made in Congress of potential tax legislation that would ultimately, if passed, if adopted, have an impact on takeover targets, the stock of potential takeover targets. And I think that the market started to react to that initially, and that triggered a number of mechanisms which then everybody sort of followed suit without thinking, well, is the legislation going to be acted? Will it happen tomorrow? Will it happen next year? And exactly what is the precise impact of it? It was an event that could come about, but it wasn't something that had occurred, and that's where I question the rationality of the market's reaction involved there. But I think that that was what precipitated the decline in the market, and then it was, in my view, fueled by computer-assisted trading. And it may well be that this same 500-point drop in one day, and over a period of 2 weeks, I believe it was about a 600-point drop, a 620-point drop or so, may well be that the market would have corrected itself over that, in that way, over a period of time, left to its own devices. It could have taken a year, maybe, or even 6 months. There were other mechanisms at play that caused it to drop so precipitously in such a short period of time.
Mr. Harif, I suspect you may have a different perspective on this, but I just, in commenting on what Ms. Peters just said, shouldn't we consider that a wonderfully efficient market, that it takes this adjustment that would have taken a year and it does it in a period of a week?
Well, economists that like to think that markets are efficient really do tend to think about quick reactions to new information as being a desirable outcome. I'm not sure in this case we'd all agree that the outcome was so desirable. Let me make some general comments, though, on your question about is the system broke. I think a lot of the post-mortems that have taken place in the United States in the aftermath of the crash have focused on a couple of things. Namely, they focused on the regulatory environment in the United States and how that might best be fixed, and they focused on the role of futures instruments and the new index trading and strategies that incorporate these new trading instruments. I think it's worthwhile emphasizing, however, that the stock market crash that took place in mid-October was a global phenomenon. It took place in countries with widely different regulatory regimes. Some of these countries had extensive regulations very similar to our own. Some of those countries had virtually no regulation. Some of the countries had futures markets similar to ours. Some of the countries had no futures markets. It seems to me that the focus then on the regulatory regime in the United States and the role of futures has been exaggerated. It seems to me that the main problem in this particular episode was one that simply the trading volumes far outstripped the capacity of the various exchanges and market mechanisms to cope with those large trading volumes. The capacity simply wasn't there, and that's a problem that's likely to be rectified by private market participants themselves. So I would be suspicious of explanations of the stock market crash that focus too heavily on the regulatory environment, and I wouldn't be very optimistic that any potential regulatory fixes that we would introduce in the United States that might address things like margin requirements, capital requirements, or price trading limits would be able to effectively prevent any similar episodes from occurring in the future.
How do you feel about the Brady Commission, the Brady Task Force recommendation that there's a need for an overarching regulatory structure to oversee trading in these various markets, and that the Federal Reserve would be the best place to put that new responsibility?
Well, I have to say that I'm a little bit suspicious about the need for a super regulator of that kind, and I'm particularly suspicious about the Federal Reserve's involvement as the overarching regulator. For one thing, I think one of the strengths of the system we have today is the diversity that it does have. The index futures markets and the underlying stock markets are clearly closely connected, but they also serve a complementary role, and I think it would be a mistake to try to impose too much uniformity in regulation. I might also add that I don't believe that the Federal Reserve is particularly anxious to add supervisory responsibilities for the operation of these securities markets to its already fairly extensive portfolio. I think they already are concerned about the extent of congressional supervision and oversight that they have, and they presume that this might induce some further congressional inquiries into their conduct of their main responsibility, which is monetary policy and preserving the overall stability of the financial system.
I want to get back to that quickly. Let me just I said jokingly that isn't it a wonderfully efficient market that can make this 500-point adjustment that should have taken a year in one day, I got a note from Professor Silver that he thinks it is a good, wonderfully efficient market. So I think we should let him elaborate on that a little bit.
You mean that you're going to let me put my foot in my mouth? Is that what you're going to say?
Well, I wouldn't pass up that opportunity.
Let me see if I can try to avoid accommodating you. It's interesting that one of the main questions that has been asked with respect to the decline is to what extent did the options and futures markets play a role in this thing? And I know Commissioner Peters just mentioned that in passing. In part, the severity of the decline can be broken down into the size of the drop and the speed with which it dropped. And I'm less concerned about the size. I mean, I tend to think that the size of the drop is something that either flows from fundamental information, and Commissioner Peters mentioned a number of congressional issues. Everyone can point to something specific. And I really don't know what it is, okay? I just know that, and the market knows that, lots of people decided to sell. And what the options and futures markets allowed people to do is to make those sale decisions quickly, because the costs of transacting in the options and futures markets are a lot cheaper than the cost of transacting in the underlying securities. And what that meant was when people got nervous, they were able to sell quickly. The attempt at selling quickly drove prices down very quickly, and in a sense telescoped the time frame over which the markets reacted. We might have had a 600-point drop over a month, over 2 months. Now the question is it good that we dropped 600 points in one day? Well, I, for one, would have been much happier had we stayed 600 points higher. But if we were going to drop 600 points, I'm a lot happier that it happened instantaneously for two reasons. First, it's like, how do you rip off a Band-Aid? Do you rip it off slowly, or do you rip it off quickly? Now, that's a little facetious, but let me say that had the stock market dropped slowly, remember, we forget where we were. We were at 2,500 on our way to 37,000, whatever the number was. Everybody was bullish. Had the stock market declined slowly, gone from 25 to 24 the following week to 23, well, what would have happened was lots of our stockbrokers would have been calling us and said, hey, there are a couple of bargains out there. Last week you wanted to buy those for $50, now it's only $45. And I, for sure, would have bought some of that stuff. And the people who would have been selling are, I think, the professionals who know that you never buy things when they're declining slowly. You don't step in and buy the stuff when it's declining slowly. In fact, that's when you sell it. I didn't step in and buy it because I didn't have a chance. And I think that the public, in a sense, would have been hurt. The public would have been hurt to a greater extent had the stock market declined slowly. If there's a revaluation, let it happen quickly. And I don't see any evidence that that revaluation was in retrospect so unwarranted. I don't see the stock market back up at 2,400. So if it had to happen, I think it's good it happened quickly, with one proviso, that the integrity of the system be maintained. And what I mean by the integrity of the system, with one proviso, the integrity of the system be maintained, and that is payments that were contracted for be made as promised. And that's why the focal point should be the clearing systems.
We've raised a lot of issues here for Mrs. Peters to respond to, but let me just...
That's why I said it all.
you did you should be the moderator this evening, much more provocative. But let me just ask you, Professor Silber, to follow up a little bit. One point that comes across very clearly from the data presented in the Brady Task Force report is, again, that the average investor never had the chance to get in, that you had big institutions trading, in many cases trading for their own accounts when their clients couldn't even get access to their trading systems. And it supports this with a good bit of data. It's hard for me, looking at that data, to see how you can argue that the average investor was better served by this kind of a decline in the market.
Two things. One, I didn't say the average investor was trying to get out. I said that the average investor didn't have a chance to get in, which is good, okay? And second, I hear what you say about the Brady Commission's report saying that there were large institutional investors who did most of the selling, but I didn't see the evidence which suggested that most of that selling occurred for their own account. And I'm not sure that the Brady Commission can get that evidence. I know that there were large pension funds that were selling, and they were selling on my behalf because I have a little piece of that, maybe a smaller piece than I would have had before, but I have a piece of that. And as I said, if the stock market went down, there were lots of sellers, and I don't have to tell you that there were lots of sellers. The marketplace told you that there were lots of sellers. Whether it was large institutions or not, in part they're acting as agents for others, including in their capacity as agents in pension funds and as agents carrying out others' orders. I don't see that you know that they were done, that it was done for their own account.
Well, Ms. Peters, you can deal both with Professor Silver's comments and Bill Harrof's comments, and we'll give you plenty of time.
Well, by the time Professor Silver started, I had lost track.
I'll remind you of what Bill Harrof said.
But I just would make 2 points, and then you can remind me of what Mr. Harrof said. One was, I don't recall in my comments, opening comments, questioning at all the efficiency of the market. I think I probably implied some wonder at whether or not the market was 100% rational 100% of the time, but I didn't say anything about the decline of 500 points in one, or 508 points in one day, as reflecting any inefficiency at all. Indeed, I can join in both Professor Silver's and yours statement to the extent that you do take delight in it, and that it did show some remarkable, prodigious efficiency. However, I think I would disagree with Professor Silver in his conclusion that that much efficiency within a 4-hour to 5-hour period was good, either for the investors or for the market. And there are many reasons why I think it might have been better, or that it would have been better for the market to have absorbed that kind of adjustment over a period of time. And I'm not going to say whether a month or 6 months or 12 months would have been the best time period, but I think that the dislocation that comes from, I'm not sure that maybe dislocation, but there was dislocation that comes from that kind of a precipitous change. It was a wrenching change, a wrenching event, is just not good for something as delicate and as we assume finely tuned and balanced as our nation's capital markets. Indeed, as Mr. Harrof quite appropriately pointed out, we are living in an era of international markets, global markets, and that what was going on in New York impacted markets around the world, and I think that is not good for the system. It undermines confidence, it creates dislocation, and just generally overall problems in maintaining fair and orderly markets. Fairness, as you pointed out, that had been brought into question by who was served, who was able to sell. Was the individual investor able to liquidate his holdings? Well, the findings suggest that the individual investor had some difficulty getting out of this declining market. So on balance, I say no. It lacked order, it lacked fairness, it maybe had a tendency to undermine confidence in our markets, and I think that those things are far more important in the long run.
Bill Harrof is over here chomping at the bit for an opportunity to respond to your comments about the delicacy of our stock markets. But before I unleash him, let me ask you to respond to what I understood to be an important thrust of his earlier comments. The Brady Task Force report argues that the stock market, the stock futures market, the stock options markets should be treated as one market and should be regulated in a unified way. Mr. Hare, if I understood you correctly, you're strongly disagreeing with that point and saying that that's unnecessary. Can we ask you what your feelings on that question are? Have I stepped beyond the bounds?
You're drawing me out into the frozen pond, and I'm not just quite sure how thick the ice is. I think that it's a fair question, and I think that I can formulate a general response. In my mind, it is clear that the equity market, the options market, and the financial futures market, when I say that, I do mean stock index futures, are clearly related. They interact in very significant ways, and one of the most important of which is when we talk about the equity market vis-a-vis the futures market is that these derivative products that are traded in the futures market have come to be for traders and investors equivalents to the commodity that they would buy in the stock market. I don't think that when you are considering or reviewing the regulatory framework for interrelated markets such as those, that one can ignore the link. And while we have been aware of the link to date, I don't think that that the regulatory agencies have been overly concerned, because there is nothing like a clear demonstration of how intertwined markets are to focus your attention on what may be problems. But the link is there. It is recognized by the SEC CFTC Accord, which brings the regulation of these futures more closely under a sort of joint oversight program. And I use those words very, very loosely for those on the futures side that are concerned that the SEC is seeking some sort of merger with them, very, very loosely. But we do have the SEC CFTC Accord, which calls for SEC input on the marketing on these futures, and I think that the regulatory system must, at a minimum, be coordinated. They are not independent markets, so it must be at a minimum be coordinated. Whether or not the Brady Commission recommendations are appropriate or should be adopted, I have no opinion.
No opinion on whether the Federal Reserve should tell the SEC how to regulate the markets?
None which I'm going to share with you today.
Okay. Bill, go ahead.
Well, Commissioner Peters suggested that our capital markets were delicate and finely tuned. It seems to me the main message from the events of mid-October was that our capital markets are healthy as a horse. We did go through
excuse me, what's a fine racehorse can also be delicate and finely tuned. I don't think that I shouldn't do that.
No, please, go right ahead.
I'm not confident that the two descriptions are inconsistent.
Well, I guess the point I'd like to make is that we went through a fairly traumatic episode here, an episode with tremendous volumes of trading involved, and an episode with a huge change on price. And the institutions survived remarkably well throughout all of that. And that, to me, is a sign of a fairly durable and resilient financial system. And I guess I wouldn't characterize it in that respect as delicate and finely tuned. With respect to this equalization of regulatory treatment of a variety of things like margin requirements, this is an issue that was raised. Let me point out one thing. I think it's important to understand that a lot of the debate that's taking place today about margin requirements between people like Mr. Phelan at the New York Stock Exchange and Mr. Melamed at the Chicago Mercantile Exchange is really self-serving in some respect. These two exchanges are engaged in a momentous battle for market share. The S&P 500 futures contract has been incredibly popular. It's grown very fast. And I think Mr. Phelan just looks at that as something that's taking away business from his exchange. And he's interested in dealing with the cost differential that has given the futures markets an advantage relative to the underlying stock markets. Let me emphasize a point that I made earlier, namely that although there are close links between the futures market and the underlying stock markets, these markets are really not equivalents, as Commissioner Peters suggested. If I'm an investor that would like to invest in a broad portfolio of securities, I'm not going to continuously buy S&P 500 index futures and roll them over. I'm going to buy the underlying stocks. But if I'm a portfolio manager and I want to hedge my position if things become more uncertain, or if I want to quickly adjust my portfolio position as conditions change, I'm going to do it in the futures market because it's a cheaper market to execute a trade in, it's a more liquid market, and it's likely that I'm going to have a smaller effect on price in that market than if I were to execute the trade in the underlying securities. Finally, let me say one thing about the Brady Commission report that I do agree with, and I think it's an implication that is not really drawn out very well. We've talked about the efficiency of these markets. When economists talk about efficiency, they point to several things. They talk about low transactions costs, highly liquid markets, markets in which information flows quickly and easily, and markets in which no individual trader has a large effect on price. It seems to me that the main message of the Brady Commission report is it's that last condition that's not very well satisfied. We do find in these markets that there are a relatively small number of traders that execute huge volume of trades. We do find that there's a relatively small number of institutional investors that have a very powerful effect on the market when they decide to rearrange their portfolio. And it seems to me there are potential regulatory fixes that can address that problem. We have barriers to entry into these markets that are incorporated in the Glass-Steagall Act and the Bank Holding Company Act. It seems to me if we got rid of those barriers to entry, we'd allow a more diverse set of participants into the market, more mutual fund players, more traders, more brokers, and that would be beneficial in terms of diffusing the tremendous market power that exists today.
Mrs. Peters, I sense we have an argument going here that could last for quite a while, and we don't have a lot of time, but let me ask you if you can make a very quick response to that, and then I want to move on to a few other issues before our time runs out.
Well, just briefly reiterate, I think that there is nothing inconsistent with saying that the market is healthy and that the market is still delicately balanced and finely tuned. Indeed, when I opened my remarks, I declined to say that the market was broken because it was still here after a traumatic experience to tell the story. The last thing, I guess, that I found particularly provocative was to say that I said that futures and stocks, or stock index futures and equities were equivalents. I'm not sure that I was wrong, but I didn't say that is a wrong statement, but I think I said that traders perceived them to be equivalents and therefore developed elaborate hedging strategies and trading strategies based on those assumptions, pretty much all of which have been developed by economists. But in any event, those are the assumptions on which the market is based, and I think that the debate ought to focus on that.
Professor Silver, let me ask you about this question of margin requirements. I don't know the precise numbers, but I think we're dealing with a situation where in the cash market you have to put up something like 50%, and in the futures market you only have to put up something like 10%. Is there anything wrong with that in your view? Is there a need for tighter margin requirements in the futures market?
Well, I think there are points on either side. The first thing that we have to remember is that margins in the futures market and margins in the stock market are not the same thing. Even though we use the same word, they are different. And in the futures market, or in the stock market, margins are a down payment on stock that you've purchased, whereas in the futures market, margins are a good faith deposit, a performance bond, if you want to think about it that way. And the clearest example is that both the buyer and the seller have to put down margin in the futures market. The second point that you have to remember is even though they're different things, which would suggest there's no reason for them to be regulated simultaneously, they both provide a buyer with the control over the price movement of the underlying security. So there is something to be said for similar, if not identical, treatment. Let me caution, though, that those of us who think that by regulating margins we are going to prevent an October 19th crash from repeating itself are grossly mistaken for three reasons. First, there's no evidence that I'm aware of that suggests that margin buying, in fact, leads to prices going up faster or going down faster. Second, even with 100% margin, speculation is rampant. The last time I looked at Hialeah, the margin requirements were 100%, and there was lots of speculation. And third, if anything can be learned from the Brady Commission report, I think the lesson is that speculation was not responsible for the collapse on October 19th. Hedging was. If anything, the attempt at hedging by portfolio insurers helped push the market down because they were worried that they wouldn't get a chance to sell. So I think the collapse wasn't because of excessive speculation. It almost was because of an attempt at hedging.
That's very interesting. Let me ask, we've got just a couple more minutes here before we go and take questions from the audience, but there's one issue that is at least raised by the Brady Task Force report that we haven't really addressed here, although the answers may be implicit in some of the comments that have been made, and that's the question of whether there would be any value to having some sort of daily limits on the swings allowed in stock prices. And there are some such limits in the futures markets now, I believe. Professor Silber, let me start with you. Do you see any value to those sorts of limits?
I think of all the proposals, limits are probably, the suggestion of limits are probably the ones with least merit. I hate to say, limits are almost un-American. They're not going to let you do what you want to do. They're not going to let you sell if you want to sell. And while I have some sympathy with regulating what you do when it hurts other people, when it's something that you want to do and you're going to bear the cost of doing it, whether you're doing it rationally because the stock is overvalued or irrationally, fear, I'm afraid it's going to go down more, I should be allowed to sell. So I think it restricts your behavior unnecessarily. Second, the professionals know how to circumvent limits. They can always sell in different markets or can circumvent them in other ways. So I think it's to the detriment of the public because the professionals can get around it.
Mrs. Peters, do you want to take a stab at that one?
Yes, I do, but it's a fairly touchy area. I'm going to content myself because of the context, and we're talking about imposing limits in a market where none exist, but there are markets where they do exist, like in the futures market. So, but I will content myself with saying that I find that Professor Silber's articulation of why they are, in his view, have the least merit of all of suggestions, very eloquently and persuasively put.
That was nice. I appreciate that.
Well, we're doing pretty. We're getting you further out here than we thought we were. Okay, Bill Harris, you have the last word.
Well, let me say about price limits. I also agree with Mr. Silber and Mrs. Peters, but there are pros and cons to the idea of price limits, and let me just make the other side of the argument just to be fair, even though I don't give it a lot of weight. The argument for price limits is that if there is a sudden and large move, the idea that you impose a limit will give market participants a pause, a time to evaluate the implications of the price move. It might break any negative market psychology that occurs at the time and give traders essentially an opportunity to reevaluate the situation. That's the pro argument for price limits. And I think that's to some extent a legitimate argument. However, there are important cons to the notion of price limits as well, in addition to the ones that have already been mentioned. If you have price limits on prices, it's going to prevent hedgers from hedging at a time when hedging is probably the most desirable, that is, after there's been a major move. To shut down the market after a large move has taken place precludes options of hedgers to protect themselves further from any additional declines. Moreover, there is an argument that if you have artificial price limits in place, to the extent a price starts moving toward the boundary, a trader and traders understand that, it may actually accelerate the move toward the boundary. That is, if traders see that the price is approaching the boundary price, that may very well provide an incentive for them to try to get out of the market in a hurry and push it over the...
Okay. Okay, we'll open the floor up to questions, and we have one right here.
I'd like to address this question to Mr. Silver and Mrs. Peters. I have read recently about a proposed linkage for the Chicago Mercantile Exchange, which would allow the exchange to operate in the off hours when the open outcry system is not open. Now, we all know the trend towards global trading is occurring. At this time, when we're trying to figure out what the regulatory response is this the right time to be talking about opening up a linkage that will allow that trading to continue around the clock?
Are you talking about the proposed linkage between the CME and a Japanese exchange to trade futures?
Yes.
That's the one?
I thought you were going to answer.
Can you-
Well, I have an answer. The answer
is
is that I believe that proposal has been put on hold for the time being, and certainly part of the reason was born out of concern that today's environment may not be the right time, and we needed to look to see what the implications of the October market break were, or at least
Mrs. Peters,
whoever's concerned needed to look.
could I ask you to explain very briefly what the proposal is?
As I understand it, I'm at a slight disadvantage because it has been before the SEC, but we haven't reviewed it because they're not going to go forward with it until after some of the answers that have been raised in the October market break are responded. But it is a proposed electronic linkage between the Chicago Mercantile Exchange and, I believe, the Tokyo Stock Exchange for the trading of futures, financial futures.
Professor Silver, as a New York trader, do you have any...
Well, there have been proposals to link trading systems. There are a number of linkages currently in place among futures exchanges. And my response is, trading occurs overseas in any case. The professionals have access to that trading because they have offices throughout the world. And I like to think of there may be some problems with futures markets, but one of the things that futures markets do is what I like to call democratize the system. And that is, it can bring to individuals the same facilities that professionals have. That may be bad for them if we think we know better than they do, but what this linkage will do is allow someone who wakes up in the middle of the night, maybe it was October 18th, and say, boy, things are really bad. I'd like to sell some of this stuff, but I have to wait till the opening Monday morning. It would allow them to sell the securities or the futures that represent those securities at a time when they feel they would like to. And I think that shouldn't be a minus, and it shouldn't be regulated.
You have other questions? Over here. Yeah, if you could come up a little closer to the microphone.
I'm somewhat concerned about the focus on 2 days of trading. I've been a student and analyst of the market for 25 years, and this has not been an unusual period if one looks back over a 100-year period. In fact, the market in this period from August 25th and October 26th, which was the actual low for most stocks, tracked almost day by day what happened between September 3rd, 29 and November 13th, 29. Both in percentage terms and whether the day was up or down in the magnitude, and also the trading volume. My own observation was that the market started acting in an abnormal way starting about October 8th and 9th, that Friday, and then started being very peculiar on Wednesday, the 14th, when that proposal came out of the Ways and Means Committee regarding deductibility of interest on takeovers. So my question is really directed to Mrs. Peters, since I gather you're actively involved in the study and the other two participants are not. Is the staff work sufficient on these studies? Not only the SEC study, but the other studies, the Brady and the New York Stock Exchange Commission studies, to actually look at the markets when they started acting in an abnormal behavior, such as October 8th or 9th, and going on to the actual low on October 26th.
Well, sir, I think if you think back a half an hour or so, when I made my opening remarks, I didn't start with October 19th. I started with the week of October 12th.
I take full responsibility for the two-day focus.
And and indeed, the Brady Commission report starts with October, or focuses its analysis on a 2-week period as opposed to a 2-day period. Now, yours starts with October 8th or 9th. So that's the Friday or the Thursday before October 12th. I think you could, one may allow some latitude to the researchers as to whether or not they start with the Monday or the Friday, but the Brady Commission certainly has focused on there. I have, our 600 pages have not have been finalized yet, but I'm confident that our staff, the SEC staff, will focus on a sufficiently broad period of time so that the analysis and any recommendations born of the analysis will have some significance and meaning. I'm quite confident that it won't only focus on the 19th and the 20th. None of us in our conversations or our discussions have done that to date.
I have a follow-up on that, and that is...
Okay, very quickly, because we're short on time here.
We've talked a lot about the uniqueness of this period, when in fact there are other periods in market history that are quite similar, not only 29, but the rich man's panic in 1907, in terms of percentage technical action and so forth. And yet, some of the things these studies have focused on were not existent in those times. And so maybe we ought to be looking at what the commonalities are between these periods, rather than what the uniqueness about this period is, to look for an answer to the questions that are before us.
Is that to me?
To any, I get it.
I think it's an excellent suggestion. I think that when you, the more things change, the more they remain the same, and we study history for the lessons that they provide for the present. And I think that looking back at 1907, 1929, and so on, can certainly provide some insight, or might provide some insight, and should be sufficient reason for looking back as well as looking just over our shoulder.
I don't disagree. I think, however, the environment is so different today that that's not to say that makes the decline unique, but the environment is so different today that while it will provide insight, I don't know that it will provide solutions and answers. But clearly, we should not ignore history.
We have a question right here.
I notice we've been talking about the stock market for a whole hour, and nobody's mentioned corporate profits. And my question is, how come? Because the stock market is really the marketplace where corporate profits are traded. I think Professor Silver's observation that the sudden drop benefits the small investor rather than hurts him. Because if you look, the fact is that at the 2,700 level, the Dow Jones Industrials was way above its historic relationship to corporate profits as defined by the Department of Commerce. And the correction took place suddenly, which was far less painful to the small investor than a slow correction would have been. It prevented a lot of people from getting out when they shouldn't have and buying when they shouldn't have.
Anyone care to comment on the relation or lack of relation between the stream of corporate profits and the value of the stock market?
Before I comment on that, let me just say I hope that I'm I'm not remembered here as the person who said it was good that we fell.
You will be. I mean, you will be, and I have the napkin to prove it.
I don't think it's good. I would have been much happier at 2,700. However, if it had to drop, I think it was better that it dropped quickly as long as the system remained intact. It did, and I think to a large extent because of what the Fed did. Just one point about what you said in terms of corporate profits. Corporate profits are only half the story in stock prices. The other part of the story is, what do you discount those corporate profits at? And there are two factors for the discount. One is the interest rate, and second is the risk. And if there's a silver lining to October 19th, it's that we were reminded that stocks are risky. And we buy stocks because they provide a higher return in the long run. We get that higher return because they're a lot riskier than Treasury bills.
John Macon?
I want to introduce symmetry into the discussion, and I have a question for each of the panelists. If the market on October 19th had gone up by 500 points, the markets would have been disorderly. I think a lot of more people would have thought that they were fair. And really, the question, we find that we always get worried about the markets when they go down.
Never when they go up.
But I remember you could show a tape of traders jumping around with orders when the market was going up, and it looked just as disorderly as when it was going down. So let me ask you, would we all be sitting here if the market had gone up by 500 points?
Who wants to pick that up?
I'll give it to you.
No, you seem to have no
you would
competition.
as a trader. Perhaps it's unfortunate that the discussion focuses on the fact of the decline in and of itself. But I'm not confident that an increase of 500 points in one day brings about disorderliness in the markets. If the markets are going up in some sort of recognizable incremental fashion, it means that there are buyers and sellers out there buying a commodity, selling a commodity for which someone is ready to put money on the line to buy. The disorderliness of the market of October 19th, just focus on one day at the risk of creating a problem to my right here, is that there was an incredible imbalance of orders. People wanted to sell, but no one wanted to buy. No, there were not, sir. There were not. That's why the markets didn't open at 9:30 on the dot every day. That's why there was a decline, because if someone wanted to sell a security at $10, they couldn't find it until they got down to 10 cents. There were not. I mean, ultimately, at the end of the day, for every transaction that was actually completed, executed, you matched up a buyer with a seller, but there were queues of people out there wanting to engage in a transaction that could not find the other side.
But that doesn't answer the question.
Bill Hare, if you have a quick comment here.
Just a quick comment. I think Mrs. Peters makes the right point about that. I mean, to the extent that we would be concerned about a 500-point rise in the same day, it would have to be because of congestion in the market and the inability to execute trades on the part of some participants. And it does seem to be the case that there were problems of that kind that appeared, and that certainly is a symmetrical problem.
Should you gear the markets to handle the volume that occurred on October 19th,
Certainly.
when it's going to happen once every 30 years?
Well, we don't know that it's going to happen once every 30 years, and so I think that you have to be ready to handle volume as it comes along. Incidentally, you say I didn't answer your question. Perhaps I didn't, but I think that to the extent that a 500-point increase in the markets reflects volatility, then at least from a regulatory standpoint, we would be almost just as concerned if it didn't have any relationship to other market factors that would make sense. When the markets bounce up and down, there is reason to be concerned if it reflects undue volatility.
We have just a few minutes left here, so if we can, keep the questions and answers short.
Would it be catastrophic if we eliminated the futures and options market on stocks?
You don't think we could do that? Maybe at least eliminate program selling?
Well,
I took the other one.
Yeah, that's it.
I don't think it would be catastrophic. I mean, the world existed without futures on stocks for a very long time. In fact, until only about 5 years ago, we didn't have them. But the point is, we may do without refrigerators, and we may do without television sets for a long time. They make our life more comfortable. They reduce, in particular, our transactions costs, and that's what futures markets do. They reduce our transactions costs, allowing us to respond more quickly to whatever we would like to respond to, whether it's rational or irrational. And I like to think that it's better if I can act without paying a big fat commission to my stockbroker, and instead just pay a little commission for executing my futures order in protecting my portfolio, or my mother's portfolio, whichever it is.
Maybe we should reduce commissions on stocks?
I'm in favor of that, for sure.
Bill?
Some people have blamed portfolio insurance and tend to link up portfolio insurance with the new futures market instruments. But I think in the answer to your question, it's worthwhile to mention that portfolio insurance strategies have been around for at least a decade longer than the futures market instruments have been around. It's possible to do portfolio insurance in the underlying securities. It's just cheaper to do them with futures.
Over here?
I don't believe I heard any discussion about the stock exchange specialists. And as we take a look at structural problems and a lack of market makers and monopolies, it seems to me that the specialist system and the capacity of the specialist system, or the restrictions on capacity imposed by the specialist system, should come under examination. And that leads to the broader question I'll toss out to you all for comment, and that is, as we look at the whole market-making process, have people gotten to the point where they no longer look at the market makers as a source of liquidity, or are they looking at the market makers as an insurance company to protect them against loss under any circumstance whatsoever? If they have that perception, or if the regulators have enhanced that perception, then I would say that is something that has to be undone.
Professor Silber, since you're a market maker, we'll let you start.
Well, I think that the question, monopolistic practices aside, whether the specialist is or isn't a monopolist system, I think we expected too much of market makers. Market makers are not there to prevent a drop in price when there are sellers. What a market maker is there for is to provide a linkage between orders that sometimes are sellers and sometimes are buyers, to bring together the buyer and seller, to provide, if you will, a temporary repository of orders, but not to stem the decline. And the specialists should not be blamed for not having taken the other side of those trades. There wouldn't be any left if they did.
Mrs. Peters, we have about 30 seconds left here.
I agree, and I do not think that, at least not in the 3.5 years that I've been at the SEC, that the regulators have done anything to enhance the idea that a specialist or a market maker is a guarantor that you will be able to execute your trade at whatever the price is. I think it's safe for me to say that's certainly not my view, and I don't know that it's the view of anyone else at the Commission.
Thank you very much. I want to thank all the panelists for joining us tonight and all the audience. I'm sorry we couldn't get more questions.